Business Insight, where you get some details behind the leading business headlines and key data releases. At the IMF Spring meetings, just an hour or so ago, we had a talk featuring the central bank governor, Mr. Olayemi Cardoso, entitled Reforming Monetary Policy in Nigeria. The administration has set out an ambitious reform path to restore macroeconomic stability and develop a pro-growth agenda, including fuel subsidy reforms, unifying various official foreign exchange windows, even in the first few months in office. We will look at this speech where he spoke of the importance of rebuilding trust and made it clear, despite reports that reserves are at a 6-year low, the focus is not on using reserves to prop up the naira. We also replayed the IMF Spring Meetings Economic Outlook yesterday by the chief economist Pierre-Olivier unveiling the latest global economic outlook. The IMF raised its global growth forecast slightly, adding that the global economy has proved surprisingly resilient. Now, first to remarks of the Nigerian Central Bank Governor today in Washington.
And also, I had to reach out to various stakeholders, particularly the international investors. And in actual fact, the first day I started at the bank, one of the first groups I dealt with were the international investors, because they had been following activities and they were very keen to know what was going on. And I felt it was very important to continue to have that dialogue, which I did, and use that as an opportunity, as I said, to rebuild trust with people and with various stakeholders. And then, of course, the next thing in terms of sequencing was to make it abundantly clear that the era of interventions, which really hadn't taken us anywhere, were over. There was a lot of worry with respect to the excess money supply, and one had to take bold measures with respect to mopping up liquidity, and then subsequently, of course, hiking interest rates. And I cannot overemphasize the importance of trust. I cannot overemphasize it. And to be honest, when I look back on it, irrespective of the courage, the boldness to do certain things, and the understanding of issues that many may not understand by virtue of the fact that you have access to data and other things, if the trust isn't there, you will suboptimize. So it's clear to me that trust is so critical in successfully anchoring a major task like this. Trust is very, very, very important. And then in terms of lessons also, I think a bit surprising, quite frankly, that perhaps one had expected that there was a greater understanding of a lot of the issues. Complex though they are, one expected there was a greater understanding. And then another lesson is the fact that one found, and again, communication is very important in this, that expectations of people of the central bank, in my view, were, totally misplaced. People expected you could wave a wand and that would be the end of the problems. And in fact, in many cases, blamed you for the woes that you had nothing to do with, other than the fact that you were there to try and find solutions. And on one or two occasions, I actually had to remind people that, listen, I didn't do this. I am part of the solution. Now, I want to try and make this as clear as possible. It is not our intention to defend the naira. It is not. And much as I have read in the recent few days some opinions with respect to what is happening with our reserves and the central bank defending the naira, if you think back to what our overall policy and philosophy has been here, you can see it's counterintuitive. Okay, basically, what we're encouraging is for the markets to willing buyer, willing seller, price discovery. And ultimately, I perceive a future where central bank will really not need to intervene, okay, except in very, very unusual circumstances. What is important to us is that there's sufficient liquidity in the market, which I've spoken about here today. Fine, 1 billion is the outlier. Sometimes it's 600, 700 million US, as the case may be, and that will continue, hopefully. So as long as we have a vibrant currency market, why do we need to go in there to intervene? We don't need to.
In his blog yesterday, Pierre-Olivier, that's the IMF chief economist, said that despite the gloomy predictions, the global economy has proven remarkably resilient, with steady growth and inflation slowing almost as quickly as it rose. The journey, he adds, has been eventful, starting with supply chain disruptions in the aftermath of the pandemic and energy and food crisis triggered by Russia's war in Ukraine, a considerable surge in inflation followed by a globally synchronized monetary policy tightening.
The global economy continues to display remarkable resilience, with growth holding steady and inflation declining. But many challenges still lie ahead. Global growth was 3.2% in 2023 and is expected to remain at that level both in 2024 and 2025. This represents a 0.3 percentage point upgrade from our October projections for 2024, with stronger activity than expected in the US, China, and other large emerging markets, but weaker activity in the euro area. Inflation continues to come down. Median inflation will decline from 4% at the end of last year to 2.8% by the end of this year and 2.4% at the end of 2025, and most indicators continue to point to a soft landing. Now, resilient growth and rapid disinflation are consistent with favorable supply developments, including the fading of energy price shocks and a striking rebound in labor supply, supported by strong immigration in many advanced economies. We also project less economic scarring from the crisis of the past 4 years, although estimates vary across countries. But we now estimate there will be more scarring for low-income developing countries, many of which are still struggling to turn the page from the pandemic and cost of living crisis. Risks are now broadly balanced. On the downside, new price spikes from geopolitical tensions, persistent core inflation, or a disruptive turn towards fiscal adjustment could slow activity. On the upside, faster disinflation or timely structural reforms that boost productivity could support activity. Insufficient action on the fiscal front could also stimulate growth, although this could force a more costly adjustment later on. Inflation trends are encouraging, but we are not there yet. Somewhat worryingly, progress towards inflation targets has stalled since the beginning of the year in some countries. This could be a temporary setback, but there are reasons to remain vigilant. Oil prices have been rising, in part due to geopolitical tensions, and services inflation remains stubbornly high in many countries. Further trade restrictions could also push up goods inflation. Bringing inflation back to target should remain the priority. There are stark divergences also between countries that call for careful calibration of monetary policy. China's economy remains affected by the downturn in its property sector. Domestic demand will remain lackluster unless strong measures address the root cause, and monetary policy can afford to be more accommodative. A key priority is to rebuild fiscal buffers, especially in an environment with high real interest rates, modest growth, and elevated debts. Unfortunately, planned fiscal adjustments are often insufficient and could be derailed further given the record number of elections this year. Credible fiscal consolidations can help lower funding costs, improve fiscal headroom, and financial stability. The key is to start early, gradually, and credibly. The second priority is to reverse the decline in medium-term growth for low-income countries. Structural reforms should promote domestic and foreign investment and increase fiscal revenues. These countries must also improve the human capital of their large young populations, especially as the rest of the world is aging rapidly. Artificial intelligence also gives hope for boosting productivity. It may do so, but the potential for serious disruptions in labor and financial markets is high, and the right infrastructure and regulations are needed. Third, global growth prospects are also harmed by rising geo-economic fragmentation. Trade linkages are already changing. Some economies could benefit from the reconfiguration of global supply chains, but the net effect may still be a loss of efficiency, making the global economy less, not more resilient. And the broader damage is to global cooperation.
On Africa, it was clear that the global recalibration and reglobalization that's ongoing could offer opportunities as investment appetite towards the continent improves, with capital moving into what could be a strong potential for yield and expansion, especially as interest rates slowly come down in developed economies.
I'd add that, after 4 years of quite a lot of turmoil, this is the year where we really see a turnaround in investor appetite for Africa. So yes, growth in Nigeria, steady, but actually rising this year from 2.9% last year to 3.3% this year. We've seen an expansion from the recovery in the oil sector with a better security situation and also improved agriculture, benefiting from the better weather conditions and the introduction of dry season farming.
In Nigeria, comments were positive. Nigeria is moving in the right direction, he says, definitely, but perhaps not with enough momentum for a longer-term sustainable growth. As IMF revises upwards the 2024 growth to 3.3% from 3% in January, but reduces 2025 growth to 3%, lower than its previous January forecast. My sense is that IMF sees the correlation between oil prices and growth seen as potentially firming up with better production possibilities for Nigeria in 2024, but yet to see any new major driver able to take growth to over 4%, talk less of the 6% growth required to noticeably improve the quality of life for Nigerians. And at a time when fiscal buffers are depleted and geopolitics unpredictable, it just means to overcome the tepid outlook, a fresh reimagination of vision and strategy is needed, especially in Africa, to break from the gravity of poverty and tepid improvements. New answers are needed for Africa to see rapid growth and technological advancement, which it needs. But the IMF is calling it either the tepid or the transformational 20s. If it has to be transformational, it must start with a new, much more aspirational vision of what transformation could be. Well, that's it from me on this special episode of Global Business Insights. This is Bode Oshosami. Please share and kindly follow on Facebook and LinkedIn. Subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.